It's that time of year. The holiday shopping season is kicking off. So we thought we'd do a little bargain shopping for our portfolios, that is. We're taking a look at 3 stocks that have been beaten down this year to find out whether they're buys. Joining me here in studio is Jason Moser, analyst for Motley Fool One, a premium stock picking service, and manager of a real money portfolio on Fool.com. Jason, welcome back.
Thanks for having me.
It's so good to see you.
It's good to see you too.
So let's start off with Chipotle.
Sure.
The stock is, I should say that this is a very popular place to eat.
Very.
Yet, if we look at the stock chart, it's down 20% on the year, 40% since April, on concerns that same-store sales could slow next year, increasing competition, and now we've learned that famous hedge fund manager David Einhorn has initiated a short position in the stock. It's trading at a PE of nearly 30. That's down from 50 back in April.
Right.
So what do you say? Are shares a bargain?
Well, I do think they're certainly more attractive now than they've ever been before. And really, this all started when Einhorn presented his short thesis back at the beginning of October. The stock fell then, and I think that really set it up for another fall when they announced earnings and announced the slowing comps there. So, you know, we're looking at Chipotle as a business that traded at a premium. You mentioned 50 times earnings. I remember seeing it creep upwards of even 55 at one point. When you look at that with its, you know, comparables, something like a Panera or even a Starbucks that traded more in the 35-ish range and even lower, Chipotle looked very expensive. But what we have to look to also is the growth that's still available for Chipotle. Now, with about 1,300 stores today on a nationwide scale, there's still room for easily, they could double that footprint over the course of the next 5 to 10 years. And here's sort of the wild card that I think a lot of people aren't really taking into consideration is their new Asian concept, that shop house Asian concept, where they opened about a year ago in DC here. They've tested it out. They've sort of tinkered with the menu to make it more attractive and palatable for consumers. It's proven successful. They're going to open another one in Georgetown, as well as another one in LA in the first half of 2013.
Let me ask you about this notion of increasing competition, because it's one of the main reasons that David Einhorn has said that he's shorting the stock.
Yeah.
We know that Taco Bell, which is owned by Yum Brands, is going to launch some new menu items with higher quality ingredients, akin to that of Chipotle, so they say.
Right.
But they're going to charge lower prices for that. What does that mean for Chipotle's margins?
You know, honestly, I think that Einhorn might be looking through some rose-tinted glasses when he's comparing Chipotle to Taco Bell. Truthfully, having tried both, I don't see the comparison. Taco Bell, for me, it's a completely different concept. You know, at the end of the day, I think Taco Bell's new menu, it's going to offer current Taco Bell patrons an option to trade up to a better menu item. I don't think that Taco Bell is going to take too many consumers away from Chipotle. We do see this ebb and flow in these higher scale restaurants, these fast casual restaurants, and so slowing comps certainly is one of the reasons why the share prices come down, but it's a major quality company, and I think this represents a great buying opportunity for long-term investors today.
All right, let's move on to Netflix. The stock is down 15% on the year, but it's been a real high flyer. If you go back to last year, it was trading around, what, $300 a share at its all-time high, so it's down 75% from there, yet it still has a nosebleed PE of 1,950. Do you think growth expectations are too optimistic here?
Well, it's really hard to say at this point. You know, Netflix has been it's been a tremendously volatile stock, and you know, when we go back to the beginnings of the company, when they were just DVD by mail, the concept was unique. They were the only player in that field, and they ruled the space. The problem is technology has caught up. Now streaming is the flavor of the day, so to speak, but I think that's going to be the way things go for a long time to come. In streaming, the barriers to entry in that market are just not as high as the DVD by mail. So what Netflix is recognizing is a lot more competition. We've talked about this before. Toys R Us is now even streaming video, which, I mean, can you imagine Toys R Us competing with Netflix and streaming? Now, I'm not saying they're going to give them a run for their money, but the point is that there is a lot more competition, and those barriers to entry are much lower, which makes Netflix a tougher story, I think, for investors.
And it would seem to me that the content providers are the ones that really hold the cards, because who's to stop them from streaming content themselves and monetizing it?
Well, they really are, and I think Reed Hastings has made mention of that a number of times in conference calls, that the 2 primary competitors for Netflix's concept going forward are going to be HBO and their HBO Go concept, along with the concept of TV everywhere, which basically takes these content providers and gives them their own little apps on something like an iPad or any other tablet. So instead of streaming something through Netflix, maybe I would just stream it through ABC's direct app there. And so, yeah, those are 2 big threats that Netflix is going to have to overcome.
Right. And before we move on, I want to get your take on activist investor Carl Icahn's stake in Netflix. He's taken a 10% stake, 1% directly through stock, the rest through call options. Netflix has retaliated with a so-called poison pill. How does this factor into into the investment thesis?
Well, for Netflix, it's been an uncertain story for quite some time. I think that Icon's entrance into this makes it a little bit more uncertain, and certainly it's not good for shareholders if they have to execute this poison pill, because ultimately it just dilutes shareholders. I don't think it's going to come to that. Really, my ultimate feeling is that at some point Netflix is going to be acquired by a bigger player, possibly an Amazon or a Microsoft or something like that. But certainly Icon's actions don't bode well for shareholders in the short run.
So you think it could be an acquisition target? That's interesting.
Yeah.
All right, let's move on to the last stock on the list, Joy Global, ticker JOY. It makes mining equipment.
It does.
The stock is down nearly 40% since February. It's got a PE of around 8. That's down from a PE of 13. Seems to me the stock is sold off as the global economy has slowed, as commodity prices have fallen. You know, barring macro concerns, are the fundamentals still in place for Joy?
Yeah, the fundamentals are as sound as ever, and Joy Global is a perfect example of a company that trades right in line with that commodity volatility. So as we see the economic engines around the globe start to slow down, Joy Global knows that they're not going to be supplying so much equipment to these miners for the foreseeable future. But it's also not something that just sort of comes and goes. I mean, these miners have to plan for these types of expenditures long in advance. And so the other interesting thing about Joy Global is they already have such a tremendous installed base of equipment all over the world, which is great. But the bonus there is that they sign these aftermarket contracts to help service that equipment for longer periods of time. That's higher margin revenue that they're bringing into the doors, even in slower economic times. When the economic engine does pick back up, you're going to see companies like Joy Global really, I think, pop on that news.
All right, Jason, thanks so much for the analysis. I so appreciate it. Hope to see you soon.
Thanks.
Jason Moser, analyst and portfolio manager for the Motley Fool.